On a recent trip back to Delhi, I noticed my 20-year-old nephew is now a declared connoisseur of all things fancy and flashy. From the nearly latest iPhone to the newest fad and kicks, and a fairly elaborate Dussehra holiday plan with friends, he seemed to have it all. And when I questioned the financial feasibility, I got a stark reply. Masi, I barely pay anything for it. It's 0% interest. This got me thinking and possibly more observant. How at every gathering, the younger they got, the more high-end their phones, outfits and accessories were. And it was all on borrowed bucks and borrowed time. Retail loans have seen a meteoric rise. Over a 5-year period till March of the last financial year, lending growth in the unsecured segment has been a whopping 27%, stripping growth in the corporate segment. And a large part of this lending targets the young new borrower, who may or may not have the financial strength for it, but definitely have the aspiration for it. From a generation of Indians who thought Karza was a curse, to a generation now that thinks of buy now, pay later as a birthright, which can be backed by a record high credit card outstanding in India, which stands at 2 lakh crores. Is this setting the stage for a ticking credit crisis, where India, which once bet big on a demographic dividend, may have to face some demographic debt drama first? Has the aspirational earner counted the chickens before the eggs of income have hatched? And do credit scores and financial strength checks of the new age retail borrower need an overhaul? And is the problem already so grave that there is a budding new business in retail debt resolution? We speak to those who have been affected.
I was paying around 75K in a month just as EMI for all the loans and credit cards and everywhere. Because every time I took another loan, I had no plan on how to repay it back. I got absolutely chaos of financial issues.
Those who are tracking the data and predicting the trends.
All credit cycles, historically has resulted in some kind of an event on a later date. So one has to be cautious about it.
And those helping debtors who got sucked by the vortex of overlending.
The way the retail credit is growing in India, and especially for the consumption, the lifestyle needs that we are seeing, it is definitely a matter of concern.
It's Thursday, September 21st. From The Economic Times, I'm your host Anupriya Nair, and you're listening to The Morning Brief. In a recent article for ET Prime, my colleague Mukta Varia highlighted how 1 in every 3 shopper in the country is a Gen Zer, and how actively the growing retail market is gunning for this mass consumer. And with the sellers come the lenders.
क्या? तो उसी में है पे
और पे लेटर ऑप्शन से बिल 1 महीने बाद भी भर सकती हो।
का बाय नाउ पे लेटर ऑप्शन क्यों नहीं ट्राई करते? अपॉर्चुनिटी दिखे तो स्टॉक्स खरीदो, मार्जिन फंडिंग करके बाद में वापस कर देना।
मुझे तो पूरे पैसे अभी मिल जाएंगे, आप बाद में देते रहना।
अरे मूर्ख, पाओ 30,000 तक बिना इंटरेस्ट। Spend now, pay later.
And the results for the lenders have been fruitful. At 3.5 lakh crore, the unsecured segment is growing fast, estimated to grow as much as 4.6 lakh crores next year. I turn to A.M. Karthik, Group Head of Financial Sector Ratings at ICRA, to evaluate if this explosion is well-balanced or a blind bet. I begin by asking him what exactly an unsecured loan is and how big the market is getting.
An unsecured loan is a loan which does not have any tangible security underlying it. So in case of a delay or an overdue, there is nothing tangible that one can hang on to as a lender to recover with the overdue monies. So the gamut of unsecured loan runs from anywhere from a personal loan, a consumer durable loan, credit card, education loans which are unsecured, and then microfinance, which is a larger component of the unsecured loans in general. To size the market, the unsecured loans, excluding microfinance as for a system as a whole, which is a combination of bank plus NBFCs, is about 18 lakh crores. So that's roughly, about 9-10% of the overall system credit. And this segment, which is excluding microfinance, has grown at a CAGR of about 16% or so, vis-a-vis the overall credit growth, banking credit growth of about 10%. About 80% is contributed by banks and about 20% is by NBFCs.
What has changed to propel this segment into the growth numbers that we're seeing?
The decade, which is 2010 to 2020, has been a decade of growth overall for credit itself. And while the banking credit has grown by about 3 times over this period or so, the NBFC credit growth has been quite sharper, again from a lower base. The NBFC credit growth has been about 5 times in this last decade. So what this has contributed is adding a new set of borrowers which were largely unbanked in the past, both for banks and NBFCs. And NBFC's focus have largely been on segments which have been by and large ignored by banks. To top all this, the digitalization which has happened in terms of borrower level data is something which is accelerating the underlying trends in terms of credit to these borrowers who are largely into this space, smaller ticket, etc. There are a few factors which is driving it. One, from a regulation point of view itself, more clarity around co-lending, etc., which is driving this segment to an extent, both from an NBFC point of view and from a bank's point of view, because there is a balance sheet which smaller entities can leverage upon for their growth. So it's a combination of multiple things which is resulting in this growth. And having said that, entities are prudent enough. They are looking at this segment as a high risk segment. So the guardrails have been put in place in general in terms of high yields, etc., etc. So from a sustainability point of view, entities are looking at this segment as a sustainable growing going forward. Maybe it will not be at a very high growth rates that we saw last year.
Karthik, you mentioned in your report that co-lending and partnership-based AUMs have grown by over 3 times in the last financial year. This is the collaboration between banks and fintechs, NBFC and fintechs as well. But to whom is this lending really happening to?
If one is looking at an industry data, about 80% of the borrowers are less than 40 years old in the new age fintech kind of an ecosystem. Close to about 40-45% of them are less than 30 years old. But what happens is that these are smaller ticket loans. The ticket sizes in this segment, which is the fintech kind of an ecosystem where you see a good amount of borrowers in the lower age base, are less than 50,000 rupees. And the average ticket size is somewhere in the vicinity of over 20,000 rupees or so. So leveraging is a concern, but the ticket sizes are not too high. There's something that we do monitor more closely for this segment is the extent of churn. Because when you say leveraging, it doesn't happen with one lender only. I mean, there is a propensity of a borrower to jump from one lender to the other because of the ease of availability of credit. So at a system level is what one would be more prudent to look at on a risk which can pan upon for the segment as a whole.
But before the macro, let's look at the micro. The risk and ruins of the borrowers who are coaxed, convinced, and sometimes driven by need, which are on the rise.
I'm a graduate, I'm an engineer. I'm almost 33 years old. I'm a working professional. So basically, I started my job and like in the few 4-5 years, it was good. But the situation get worse during the COVID times. Actually, I have multiple sets of credit cards. I'm holding around 6-7 credit cards. So at the time of COVID, in my family, I got some medical emergencies, due to which the urgent requirement of medical treatment and the cash and all those things. So at that time, I used my credit cards, almost drained all my cards limit. And my salary is almost I got around 60,000 a month. It was not enough to clear all those bills, right? And I tried a lot of things, but I didn't get any funds even from my friends or the family. So I'm getting lots of calls daily with the multiple banks, creditors. Okay. So that is what I learned from that.
What happened was last year from the beginning, I had to take a personal loan for one of my friends, and it got me off balance with my salary, with my expenses and everything. So my first personal loan was 3 lakhs and it had an EMI of 25,000 a month. And I was planning to pay it off in 1 year. So the EMI was pretty huge. I had a CTC of 10 lakhs a year and still I couldn't manage my expenses with my salary. I mean, I was paying EMI on this loan, then I had 2 credit cards, then I had other expenses at home. I was living with 4 people at the time and all the expenses were actually on me. I was paying around 75K in a month just as EMI for all the loans and credit cards and everywhere. Because every time I took another loan, I had no plan on how to repay it back. So in like 4 or 5 months into the year, I got absolutely chaos of financial issues. It was all done in an impulsive situation. So I was completely gone by August and September. I was too stressed. I didn't know what to do. Like it was affecting my work also. Like I lost my entire confidence in work, in personal life, in financial situations and everywhere. If you have a hope that you will get out of it as soon as possible, then you can still work for it. But if you don't have any hope, it's very hard to live that way.
Borrowers are going bust, and with loan rates continuing to harden, the debt dynamics are unlikely to turn around anytime soon. In a recent note, Motilal Oswal Securities said household debt has spiked 19% year-on-year in the January to March quarter, marking the highest growth in over 21 quarters. So repayment is getting harder and harder, where the quantum of what is due is rising, while income is just not keeping pace with rates or with inflation. In fact, India's household savings have touched a 5-decade low of 5.1% in the financial year gone by, while spending and borrowing is touching new highs. Just like the corporate debt crisis gave birth to the ARC business model, the rising credit conundrum amongst retail borrowers who are being hounded by repayment agencies is making way for retail debt resolution platforms as well. TMB caught up with Ritesh Srivastav, who is the founder and CEO of Freed, a debt resolution platform that has assisted many over-leveraged borrowers get out of the debt spiral. We began by asking him what prompted him to start this business.
With the recent growth in retail lending that we have all witnessed, right, and riding on the back of consumption, the way credit is exploding, right, there are unfortunately many borrowers who end up either over-borrowing or overburdening themselves or over-leveraging themselves on the credit that they have. And that was the time when, in August 2020, when I started to look at the growth in retail lending and also the building stress among the consumers. And there was a clear need for platform, a neutral platform which was borrower facing, which could empathize more with the borrowers and help them resolve their debt and help them come out of this debt trap that they have unsuspectingly gotten themselves into. And what we saw in India happen over the last 5 years, right, ever since the focus of lenders moved away from corporate lending to retail lending, right, it was just a matter of time that you could see the stress building on account of growth in retail lending as well.
Ritesh, you've spent a lot of time in the United States as well, where we've seen this credit crisis amongst retail and borrowers really play out. Is this deja vu in India? Can you really draw a parallel at this point?
India is catching up quite fast. So, for example, in the US, they destigmatized debt a long time ago, because they've been living off credit cards for a long time, right? If you see this in India, it is quite a recent phenomena. I would say the last 7-8 years has really seen the evolution of credit in India, right? Where the young millennials and Gen Zs are absolutely unapologetic, right, about exploring new ways of credit and, rather riding very high on the aspirational curve and indulging into impulsive spending. And as a growing economy, I think, we are going to be seeing, it will be kind of alarmist to say that there'll be a negative trend in personal finances. But the way the retail credit is growing in India, and especially for the consumption, the lifestyle needs that we are seeing, it is definitely a matter of concern. A 3.4, 3.5 trillion economy with the household debt already breaching 1 trillion. Now, what is the break of this household debt, right? There is $500 billion in personal loans, okay, which are retail loans essentially. The rest 500 are in farmer loans and other, kind of uncategorized loans. But Find It billing is in retail personal loans. Out of that, secured is roughly 320, 330 in the form of gold loans, home loans, auto loans, and all, right? We have about 170 to 180 in unsecured, high cost personal loans. And that, as a percentage of overall household debt, is about 17, 18%. That is the cause of alarm. So 17, 18% of the Indian household debt is a high cost debt at a very high APR and unsecured. And where is the growth that we are seeing? It's only unsecured. Secured loans have not grown, at the same rate or even close to the same rate what unsecured loans have grown, right? A few months ago, our credit card outstanding reached 2 lakh crores, the first time ever. And the rate at which it is growing, rate at which personal loans are growing, is just a little alarming, overall as a percentage of overall household debt.
Ritesh, we also talk at a time when the iPhone 15 is fresh off the shelf, and it's kind of epitomizing the problem with many taking on loans in FOMO to just have the latest or the best. Give us a complexion of the buyers of these new buy now, pay later plans that are getting them into trouble.
I'm sure you can take a guess, right? What will be the majority of these buyers, right? Millennials, Gen Zs, many of them barely at 40, 45,000, probably committing to a 15,000 EMI. And banks are going to be basically having a field day financing this purchase because they all will come with the 18 to 24% APR, unfortunately. The growth of e-commerce, all the tailwinds, right, that we are seeing in terms of e-commerce, in terms of consumerism, in terms of over access to credit, easy availability of credit, the click of a button and all, right? I feel it's just creating a debt trap, pushing the borrower to spend more, forget about saving. We're talking about spending more, right? Not even worrying about, what they can save.
If you could just give us a little more on the landscape of these borrowers, where is this concern translating most for? Is it the debt trap being laid for the unknowing, or is it for the greediest?
88% of our customers are employed, salaried. A good 44% of them are in tier 1 cities. We have 36% in tier 2, and we have almost 20, 21, 22% in tier 3 as well. Average income for these guys is about 35 to 40,000. And of course, the total debt that they're bringing is about 5 lakhs. So you can imagine, on a monthly income of 35, 40,000, if they are carrying an overall debt of 5 lakhs, right? A lot of these consumers are between the age group of 29 to 32, a classic early millennial or a Gen Z. And this is across hundreds of thousands of customers, right, who have approached us. We have only enrolled 20, 25,000 because, we have to ensure that the customer has the ability to save as well. And typical creditor accounts they have are about 4 or 5. It's just not one account, because the psychology of debt is you take a loan to repay a loan, you take another loan to repay that other loan, and you keep kicking the can until you come to the end of the road, right? And you're back against the wall. That in itself, is an indicator of how over leveraged and how aggressive lending has been, right, to these guys. 95% are graduates. Quite a few of them are in regular white collar jobs as well. I'll just give you an instance. In Bangalore, what we saw happen after the layoffs, all these engineers and the so-called startup employees had to basically make do with a reduced salary, with whatever they could get. But the interest rates on the loans that they took while they were, earning top salaries, right, never reduced. The cost of living never went down. We are sitting at a 19-month high as far as CPI index goes, right, at the inflation. So, and with the global economic looking gloomy as it is, with the IMF reducing the overall growth to 2.7%, the global economic growth, we are probably entering a perfect storm kind of situation. Loans are only getting expensive, right? And situation is only getting worse for these guys.
So now we're in a situation where monthly payouts are far exceeding what a borrower can actually balance. Then they reach out to you. So what is the next step?
Now, once a customer has gone into default, just being in default and just being in debt is not the only problem, right? He's being hounded by collection agencies. He's being, there's a social stigma around being in debt. As you know, debt is a very negative emotion. So Freed has currently 2 debt relief solutions that it offers, right? Let's talk about, what we started off with, which was a debt resolution product. A debt resolution service or a, solution is for consumers who are already in delinquency due to a financial hardship, whatever it could be. First thing first is to make him believe that he can do it. And how does he do it? Is basically what is the monthly amount that he can commit to towards saving for his debt relief plan. And once we ascertain that amount, what is that amount after doing a quick budgeting and counseling with him, then that amount is saved up every month by means of a direct transfer or ENACH, so to say, where he's saving that money every month in a special purpose account that's created for every borrower. Why a special purpose account? Because if the customer was left to save the money in his own savings account, guess what? He will not be able to do it, right? Because he's financially indisciplined. At the crux or at the core of debt relief is fundamental principle of saving, financial discipline, which is basically saving every month, right? So Freed is just not resolving their debt by virtue of them saving every month in a trust account or in a special purpose account, and then we using a collective bargaining to resolve their debt with the respective lenders, right? That in the nutshell is the model.
So you put them in debt rehab through savings, but there would still be those who relapse, who fall off the wagon, who are not able to commit. What is your success rate with the pull customers?
We're hitting at about 50-55% customers who would graduate from the program by resolving all their debts. But this number and this performance, right, is improving quarter after quarter. We learned quite a few things from the navigating through the Indian landscape. And now we are sitting at a 50-55% graduation rate. We want to take it to 60-65. That I believe will be, good benchmark for us to achieve.
You used the word collective bargaining previously with the lenders. How is this done, Ritesh? Do lenders approach you? Are these accounts already in NPA? And how appealing is it, this process, for a lender who will be taking a haircut?
Well, I think it can't get any better, for them, right? Because what they're able to collect on NPAs is barely 10-15%, right? As I said, 12-13% is what the average is. On top of that, they have to pay the collection agency, which is collecting that, right? So net what lender gets is barely 10%, as opposed to Freed offering them a 45% up to a 50% repayment as well in some cases, right? So it's a clear no-brainer to get a 5x more efficiency through Freed. Number one. Number two, what are the debts that we are resolving for them? Those are already write-offs in many cases. In some instances, we are actually settling with ARCs who have actually bought the debt over from the original lender already. So I see nothing but a huge win-win for the lenders as well in this system. And the proof is in the pudding, right? What we have been settling, what we have been resolving for the lenders over the last, 18 to 20 months, right? Month on month, we've been growing at a 10-15% in terms of the number of accounts resolved for the lenders. And as you can imagine, 18 to 24 months growing by 10-15%, resolving almost thousands of accounts that we've already resolved for these lenders, where, forget about collecting, they couldn't even trace the borrowers, right? See, that's the advantage of being a full platform.
And after all, Ritesh, this is not you're a pull platform, but you're not a non-profit. How do you make money out of this?
So for a debt resolution program, we charge a flat rate of 10% of the debt enrolled on the platform, but we charge only when we settle. So the customer is saving in the trust account, in the special purpose account for himself. And as the savings built up, the debts are resolved progressively, one by one. And before a customer, all the debts are, resolved and the customer becomes debt-free. So he pays a 10% fee for resolving his debts, right? 45% is the estimated repayment to the creditors. So eventually a customer pays 45 plus 10, 55% of the enrolled debt on the platform. On top of that, there's a monthly subscription fee that we charge, since we don't charge any upfront fees. So we are also incentivized internally and Freed to be able to deliver more and more resolution, favorable settlements to consumers, saving them money from, this toxic debt that they've accumulated.
The banking regulator in the last financial stability report, though had highlighted the concern on the rapid rise of retail loans, also noted that they do not pose an imminent risk to the systemic stability. But as co-lending continues to co-opt more and more market share, the stress in the system will also spread. Industry data such as the Credit Bureau TransUnion CIBIL report in April is already showing stress in repayments. The credit card defaults have also edged significantly higher. The RBI governor reportedly met the heads of NBFCs at the end of August to discuss the issue, and industry sources alluded that some action from the RBI on unsecured lending, credit cards, etc. could be seen as excessive growth is the first sign of potential delinquencies. As new borrowers find their stairway to consumption heaven, the debt bomb seems to be ticking faster with every step. With that, it's a wrap on this episode of The Morning Brief. A quick shout out to the team that helped put this together. Episode producer Sarohini Jain, sound maestro Indrani Bhattacharya, and a special shout out to Kiran Somvanshi for all the help as well. You can catch The Morning Brief every Tuesday, Thursday, and Friday on the platform for your choice. Coming up tomorrow, well, you may love him or hate him, but you can't ignore him. Diya Rekhi turns to the biggest brand of Bollywood, SRK, as TMB tunes in to the changing avatar of King Khan. You don't want to miss this one. Thank you for listening in and have a great day.